Before we move to the meat of the conversation, could you help us take a look back and give us an idea of how COVID-19 has impacted family office allocation to the alternative space? Has there been a significant reduction in risk appetite or even risk tolerance for that matter? Or have allocations in that regard pretty much stayed the same, considering that they don't contribute that much to the total investable amount?
I think if I can draw a parallel here, I would say that the situation is pretty much as cold and foggy as the weather in Delhi today, after COVID. And I believe, family offices have been trying to break through this and break through the uncertainty and understand what's in store, for the future. But obviously, as you would realize, it's very difficult right now because one doesn't know the impact or the extent of impact that the pandemic has had on various asset classes, especially alternatives, because you don't price them on a daily basis, right? Unlike equity or fixed income, where you know every day what the price movement has been. In the case of alternatives, you need to take a more subjective long-term call, and therefore the uncertainty is even higher because you don't know whether you are entering at the right time, whether you're entering the right spaces. So, but if you would ask me about the allocations to the space and whether they have gone down, I don't think the risk appetite has changed overnight, because events like these have now been happening with alarming frequency. Every 10 years or so, you see a major event like this. But family offices normally have portfolios that span across generations. So if they get affected by every phenomena like this every 10 years, then it's going to be difficult to have a strong investment policy or a strong investment philosophy. So I don't think in terms of allocations much has changed, but yes, in terms of opportunistic mandates that families have been looking at in terms of slight tweaks to the kind of alternative assets that they will look at, that I think has happened. So instead of reducing the allocation to the asset class altogether, maybe they have been a little smarter about which kind of vehicle to allocate to within the asset class.
Could you expand on that for us? What kind of vehicles have seen that increase, or at least that preference from families now?
Sure. So I think one of the things that we've seen is, because you've seen the equity markets going to an all-time high, you've seen the bond yields going to an all-time low. Opportunities in the public markets are limited because of that, because, you don't know whether the valuations that you are entering at today are sustainable or whether you'll see major corrections going forward once the earnings catches up with the reality. So what a lot of people are trying to do now is on the alternative side, they're trying to see if they can somewhere hedge their positions by getting into market neutral strategies, getting into arbitrage strategies, where they're looking at making something which is more than fixed income in today's scenario and yet not taking the risk that equity has to offer. So, looking at absolute return strategies where they can look at maybe either some long short kind of positions. You would see that in a lot of direct trades. You would see that in the form of a lot of fund managers coming out with such strategies. People who've already been pioneers in that space, launching more funds, getting more capital, because I think this is one of those times when people don't want to let go of the upside, but at the same time, they're scared of the downside. So anything that protects their principal at this point in time and yet offers them a reasonable upside, more than what the debt positions are offering them today, is welcome. So a lot of family offices are doing that as far as the asset shift is concerned.
Would it be fair to say in that case that family offices are looking at something similar to a core alpha strategy?
Yes, absolutely. That I think is one. And the other thing that they're also looking at is, globally, obviously, you've seen a rise in popularity of a lot of structured notes as well. So where you try and build a portfolio of stocks or an index, etc., and build around that so that you participate on the upside and you don't participate on the downside. So things like those, things like a core alpha strategy would make a lot of sense today. Having said that, it's not that the traditional alternative assets have not attracted investments at all. So it's just that the nature of those investment vehicles has also changed slightly. So whether it's a private equity or a venture capital fund or a real estate or an infrastructure fund, I think what has happened is that these guys have also upped their game by offering a little bit more to the family offices and not just offer the standard product that they used to offer maybe a year ago or 2 years ago, when there was a lot of attractiveness of their proposition for family offices. Because we've seen those allocations go up over the last few years, starting with only an equity and a fixed income allocation. Family offices have increasingly looked at investing into alternatives and vehicles such as private equity, venture capital, real estate, infrastructure. But because of COVID, obviously there was kind of an intermediate stop to that. And to be able to get over that, a lot of these fund managers have tried and they've done some innovative things to get some money from family offices.
What are some of these innovative things? Are they saying, for example, are they giving you a co-investment opportunity on every single investment they make from a vehicle, for example, or is there something, new products depending on the type of vehicle they're making, they're constructing?
Yeah, so see, co-investment rights were always a part of what was being offered to family offices, especially at their scale and the kind of investments that they would do. Most family offices were anyway being offered co-investment rights. But what has happened differently is that those co-investment rights have gone a little deeper in terms of tying those up with the core business of the family. For example, there is a family that's in the consumer goods space, or there is a family like ours, which is in the mobility space. A fund manager who would come to pitch his product or a product to us would also kind of talk about mobility ventures that we could be interested in. And even if we don't really go ahead and invest in that fund, the kind of work that they do with the family, they will share the details of the kind of mobility company that they're looking at, or the kind of consumer goods company that they're looking at. They will try and get us on board, whether or not we invest. So these are confidence building measures which have started. Earlier, it was only for their selected set of LPs that they would open up these kind of deals. But now, even for prospective LPs, they would go ahead and talk about these deals and see if there is an interest. It's also relevant because the companies that they are talking about, they also need that money. So, and not all of that money is available with the fund or with their existing LPs. So going to these prospective LPs does both things. One, obviously, it increases the attractiveness of their own product in the mind of that family because they are trying and going out and extending a hand. So the family also feels that, okay, these guys are showing me a deal even though I'm not invested. So they look at them favorably. The other thing that happens is their portfolio companies get that much needed shot in the arm in terms of liquidity in the current times. So that's been happening. The other thing that's been happening is that a lot of these funds are also bringing out some good deals for family offices. And, I was just reading a report the other day. I think this was a BlackRock report, which mentioned the EMEA head saying that, one of the things that family offices hate more than losing money, and that's losing the opportunity to make money. Right. So I think what these guys are doing, the fund managers are doing, is they're presenting those opportunities to family offices. They're saying that, why don't you come on board? Not in my next fund, which I'm going to start from scratch, but come into my, say, a stars portfolio. A fund which is constructed out of my previous funds and, takes all the stars and gives you a certain discount on the valuation at which you can enter. Or why don't you come and, invest in the bridge round of some of my portfolio companies? They need the money and they're willing to offer you discount in terms of valuations. Why don't you do that? Or, I have a default in, some of my LPs who had committed a certain amount, but they're now backing out because of liquidity reasons. I could give those opportunities to you at cost or at a much lower premium than the market rates. So would you be interested in coming in that way? So I think
Mhm.
people are being innovative. They're trying to structure deals which are attractive for family offices, and somewhere these deals give the impression that there is a distress sale that you can participate in. And that's something that as Indians and I think as investors, all of us love. A discount or a distress sale is something that
The
we are all
value buy.
interested in.
Yeah.
Absolutely. So I think that's been happening quite a bit.
What about traditional private equity or venture capital funds? We've seen a lot of funds being floated from the end of 2019, well before the pandemic hit in the last calendar quarter of 2019. And we've also seen a few closures, and now we're hearing about some private equity funds in the mid-market space beginning to float their vehicles. So, what are you looking at over there? What are sort of some of the themes that you feel that they can leverage to get more family office participation?
So I think there is no single answer to this because different family offices will have different focus. Some of us will be interested in the early stage, some of us will be interested in the mid-market stage, and some of us will be looking at the private equity or growth capital. But to be honest, I think it's about giving that certainty in an uncertain world, right? How can you give
Right.
some certainty in terms of cash flows, in terms of in terms of the type of companies, making family offices invest not in a blind pool, but in a pool of companies that they can see and understand, and then take a call to invest. So I think these
Mhm.
slight changes will go a long way in making these funds attractive to family. I think the traditional construct of a blind pool where you would draw down commitments from investors and then decide, or when you have decided that this is the investment that you need to make, you draw down money at that point in time and keep doing that over a 3-4 year period. I think
Right.
those kind of traditional funds will have to change their model slightly, and that is why you've seen that a lot of funds that have been able to close fundraise are ones where you've got a track record already, either in the fund that just closed before this, or a fund in the same series that they have already executed, or it's a fund where they've already made certain investments. It's a star portfolio, or it's a fund where you already know that out of 12 investments they've already made 8, and you can fairly understand what the portfolio is going to look like. So those are the
Mhm.
kind of investments where the uncertainty is being reduced, and that is
Mhm.
why they're becoming more attractive in a world like this today, right? The other things that a lot of people are also doing are looking at not just equity, but even venture debt has become pretty popular, and you've seen some large funds being raised there.
Mhm.
Some of the funds that have closed have been pretty large. Some of the funds which are being launched are aiming to be large fundraisers. And again, the reason there is that the uncertainty is being reduced because you're looking
Mhm.
at a fixed coupon, then you're looking at an equity premium through warrants. So somewhere the investors have got an understanding that, okay, anything that reduces my uncertainty, anything that makes me more confident of the kind of outcome that I'm going to get out of alternatives is going to be good. Anything that offers me a discount today, anything that comes to me at a distressed valuation is going to be good. So that's really the thought process that's going on in the minds of a lot of family offices.
So then finally, could you help me put this all together and tell me what sort of themes or trends that alternative funds and vehicles across asset classes can sort of leverage to come to you and say this and this, would you like to invest? Would you like to invest in a vehicle, or do you feel that there's a greater opportunity for you to participate in them?
Yeah, so if I were to, call out a secret sauce, so to say, I would say that, the secret sauce is try to remove uncertainty as much as possible from your portfolio or from your investment thesis. Now,
Mhm.
whether that's in terms of regular cash flows, whether that's in terms of a hedging strategy that, that is indifferent to market movements, whether that's in terms of an open portfolio where the investor can see through what you're investing in, whether that's in terms of good deals and bargains that you can offer to your investor, where he can come in at a valuation which is lower than what he would expect. So, there can be different forms of reducing this uncertainty, but I think that is the secret sauce. That is what fund managers will need to do if they have to attract family offices specifically. For the regular investors, the regular framework, the regular structure may work, but when it comes to family offices, they will have to make these small tweaks and come to them and tell them specifically that, hey, I know that you are, worried about the uncertainty in the market, and this is how I'm going to tackle that. I'm going to give you a fixed coupon every quarter, or I'm going to give you visibility into my portfolio before you invest, or I'm going to help you with, finding a few co-investment deals, even if you are my prospective LP and you're not my actual LP, or, I'm going to give you a discount on the valuation that you enter with, or I'm going to, create a structure where you are not affected by the volatility in the market and you are going to get positive returns no matter what happens. So, you could structure it the way you can based on your own personal, fund dynamics. But I think from an investor point of view, you need to understand that he or she is worried about the uncertainty. And if you take that out of the equation, you will definitely get that money.
There's a lot of questions on my list here about things like market timing, efficiency, and formalization, but you've already given us a lot to chew on and think about. So I'm just going to stop here. Thank you so much, Mr. Utkarsh, for taking the time to speak with us today. It's been an absolute pleasure.
Thank you. The pleasure is all mine.